We're pitching Advanced Auto Parts. It's a little industry overview. Advanced Auto Parts operates in the U.S. automotive aftermarket space, which includes everything from parts, maintenance, to repairs to keep vehicles on the road. The industry is especially attractive due to older cars or aging fleet cars, cars becoming more affordable to the average customer. And it's also an industry where it can't be deferred. If your battery runs out, brakes run out, you can't really put that off.
So given an attractive industry, you might wonder why we think this is a pitch, given the recent performance of Advanced Auto Parts. It's a stock that's been having some trouble over the last couple of years. So we've identified a couple of problems leading to the trouble that Advanced Auto Parts has been having, namely rising inflation over the last couple of years have increased the product, labor, and fuel costs that the company is going through, and they can't pass off those costs to the customers quick enough. And so what this has led to is an increased margin pressure that the company was failing to compensate for over the last couple of years that has led to some problems at roughly 300 to 400 basis points.
Now, Advanced Auto Parts is one of the leading automotive aftermarket part retailer in North America. They segue towards DIY and as well as professionals, and as what they call it, and they operate a balanced box store model. Strategically, the company is in the middle of a multi-year operational turnaround in which they aim to simplify operations, improve supply chain efficiency, as well as strengthening their professional segment. The company has also decided to sell non-core assets, as well as closing underperforming stores, and as well as consolidating their distribution centers in order to improve their delivery time as well as their retail inventory. Now, with their management team and this problem they have, this is their solution, is their management team, which is led by none other than their CEO, Shane O'Kelly. With his experience at Home Depot, in which he led distribution networks similar to that of Advanced Auto Parts commercial network. CFO Ryan Grimsel brings restructuring as well as capital allocation discipline from his time at Lowe's. This is important because he has helped stabilize margins as well as bringing the company back into a position in which they can finally generate positive free cash flow in the future. Now, this is all well said and done, but one of the big components is also Colonel Doss, their Chief Digital Officer, who has modernized pricing as well as improved their inventory systems through analytics and AI tools. Now, this leadership team as a whole directly aligns with the company's visions of the future and help strengthen the confidence in the execution of the operational turnaround.
So with the addition of Shane O'Kelly and the other two board members, Shane brought up the turnaround strategy for it's called the 3 pillars. And the first one it focuses on is merchandising. That really focuses on the product mix, making sure that they sell higher margin goods and focus on more profitable demand. The next one is supply chain network optimization. That's kind of the main one. That's really focusing on increasing distribution efficiency by consolidating their 2 networks into one, and their store operations plus execution, which is more on the in-store with the customer experience and improving productivity, labor productivity. So with the combination of all 3, we think that Advanced Auto Parts is going to do well in the future.
So no turnaround would be complete without evidence that the turnaround was actually occurring. So from our position, we've got some evidence that Shane Kelly taking the helm has actually led to the implementation of this 3-step plan that Alex talked about earlier. And one of the things that's been instrumental in this execution has been the sale of WorldPack, which was a parallel distribution network that Advanced Auto Parts was managing. So under the time that they were undergoing this margin correction, one of the problems that they had was that there was a parallel distribution network that they had set up through WorldPack. And rather than just shutting down those distribution centers and getting rid of that portion of their business, they were actually able to sell off WorldPack to Carlisle. And that has led to $1.44 billion in net proceeds that sort of helped put some wind in their sails for the moment being. In addition, they've managed to trim some of the fat on the edges by closing 727 stores, focused on exiting some areas in the West Coast that were unprofitable, so these stores were losing money for quite some time, and opening up to new markets on the East Coast and Midwest. So alongside getting rid of WorldPac, they've also collapsed their distribution network from 38 stores on the advanced auto parts side and WorldPac side down to 16 distribution centers, and they're planning on getting down to 15 with one more closing by the end of the year. Alongside all of this, they've also been able to impressively optimize their delivery process, going from 50 minutes average delivery to professional car repair salesmen to a 40-minute delivery time. So in an industry like this, delivery time matters, and being able to get your product to the people that need it quicker on the professional side is what drives those sales. So here's where we see the future of the turnaround headed. We've got the 2025 restructure that I just talked about. Right now we're in the rebuilding phase, and Shane O'Kelly's taken that through. It looks like there's going to be 8.5 roughly billion in net sales this year, with an adjusted operating margin of 3.8 to 4.5. That distribution network is once again going to collapse down to 15. That's where they see it for the future. And the pro channel is something that they're trying to regain market share in. As I mentioned earlier, having a wide pro channel allows the company to be able to get parts to the professionals that are actually doing the installations quicker. So 2027, we see a 7% adjusted operating margin target, and that's from corporate guidance, alongside a debt leverage of 2.5 and roughly 100 million in free cash flow generation, and some dividend growth, some buybacks.
So we did a discounted cash flow analysis to underlie our implied value, and we established a base case implied price of $64.99, which is about 22% higher than the current price, assuming a terminal growth rate of 1.5% based on 1% organic sales growth and some additional store openings that will happen in the future. As you can see, they've had periods of negative free cash flow here for now beginning to return, or we project will return in fiscal year 26 to positive free cash flow as margins stabilize. So we also did a comparable company analysis here. One thing I want to point out is that their PE ratio seems high at first glance. That is only because they've only just returned to profitability, so it's because their earnings are quite low, not so much that their price is quite high. And as their earnings normalize heading into the future, we project they're quite undervalued relative to even their peer medians. And if they could re-rate just to the peer medians of their competitors, we also derive a price of $64, which is, again, about 22% higher than the current price.
So here are a couple of investment cases. I'm going to sort of skip by them real quick, and we can come back to them in questioning. But essentially, we see this as a sort of turnaround that's going to be a strong investment for even in a bear case, right? So we see the bear case right now sitting around current share price. So at worst case scenario, we're sort of breaking even. Best case scenario, from base case, we're getting up there. I think that's time. From base case, we're sort of getting up to the price range that we talked about earlier. A bull case, if we saw the market sort of expand, older cars stay on the market, demand goes up, we could see this being, a price target of 75.
That's done.
Just go to the next one. Drive the point across.
All right, so we have 7 minutes for Q&A. And Doug, you can get started.
So essentially, the operating margin is going to double between this year and next year. How does that happen?
Usually, from what we've seen and what corporate guidance has given us, the distribution centers consolidating from 38 to 15. Just that alone is going to boost margins, which we've already seen, plus along with the
Closing of 700 stores as well on the West Coast.
Yeah, so the closing of those stores
Do
and
you
finishing
see
up.
any evidence of this in the quarterly numbers?
Oh, absolutely. Starting from where fiscal year 24, when Shane first started, to now, so the margins. So the story is definitely credible with what they've done so far.
They've been cutting operating costs very aggressively, as well as headcount in terms of their ratio of corporate and support staff relative to the staff manning their stores and their distribution hubs, quite aggressively, which also helps.
Where might you be wrong?
Yeah, that's an interesting question. So if things were to change in the automotive manufacturing sort of pipeline, I think that would be something that would undercut our thesis. So we're predicting that the price for used cars is going to hover around roughly what it's been hovering around the last couple of years, and the price for new cars is going to stay around where it's at. But if that changes and say we start having super affordable vehicles on the roads in the US that are selling for much cheaper than what current vehicles are selling for, that's something that would undercut our thesis because you'd have fewer cars on the road needing maintenance. As cars age, and that was part of what we talked about earlier, is that goes on in terms of years, the sort of maintenance that those vehicles are going to need over time is going to get more extreme and more regular than what it is when they're brand new out of the factory. And so that's where Advanced Auto Parts makes a lot of its money. That would certainly undercut just the entire market that they operate within. Other than that, we do believe that the turnaround group is pretty strong.
Does gas at $4 a gallon help or hurt the company?
I would say it's kind of mixed because even if your car is just sitting in the driveway, it's still aging. So I'm sure it would affect it for however much you want to drive. But for the most part, cars are going to age no matter if you drive it or not.
But to his point, if you're not driving it as much, there's not as much wear and tear, so.
Well,
Gas is also a pretty inelastic good, so even though the price is skyrocketed as it has, you see less of a immediate reduction in driving. There is still some reduction in driving, but it's not as much because the demand is so inelastic. People still need to get from places they need to get around. So.
And if and when cars do sit for an extended period of time, whether that be weeks or months, it's the case that things break down. Wear occurs on that car, whether it's from the tires just sitting in one place consistently, or whether it's from animals getting into the brake lines and chewing through electronics. That's where Advanced Auto Parts is making their money. So it doesn't matter whether those cars are driving and incurring risk and damage, or whether those cars are sitting and incurring that wear and tear over time. That wear and tear is going to happen regardless.
Does the company break out the margin difference between pro and do-it-yourself?
Yes, I believe it's around 50% kind of split evenly right now.
Yeah, so we've got it up here, right? By part type and then by customer type, we've got the splits down here in the corner. And so by part type, it's 65% going to be for parts and then consumables, and then by customer type, the pro is roughly 50-50. So,
And do you know which one is more profitable?
Pro is more profitable.
Profitable.
But
How has that mix changed, or has it?
they've lost some of the pro as they've gone through this change, and so what Shane O'Kelly is trying to do is recapture that, right? So as this was happening and as they were leaning down their distribution center network, one of the worries that pro had when they were buying was the supply chain, right? And that's something that they've actually been able to cut times down for deliveries, which speaks in favor of recapturing some of that market share, because the pros are looking for someone that can get them the part as soon as possible so that maintenance can be done, that car can be out of the garage, and they can have a new customer in there.
And to add on to his point as well, they're also trying to mix in kind of higher margin goods in their DIY and kind of prioritize those rather than traditional lower margin goods that they do so.
This is a pretty crowded space. You got AutoZone and O'Reilly and what's the other one? Napa. What distinguishes one company from the other? Is it location or is it?
I would say they kind of hit on
The three questions that get asked first is, do you have the part, how fast can you get it, and the price. And if you can hit the first two, then that's really where you get the better competitor.
That's from the pro side, right?
Yes.
Yeah, okay.
What about the DIY side? Is it similar checklist?
Absolutely. Definitely having the part in store is the biggest one. Definitely having the part first, or how fast can you get it, because if you don't have the part, I'm just going to go next door to AutoZone and see if they have it.
And that's just by virtue of what the part is for, right? We rely on our cars every single day in order to get to work, in order to go places, in order to get groceries. And so it's something that's so essential that the driving factors there are going to be the supply, and there's always going to be that demand.
Does them narrowing down from like 38 distribution centers to 15 does that impact their ability to, how does that impact their ability to deliver?
It actually improves it the most, because before they had their kind of inventory scattered in all these different locations, but now they're basing more regionally in their larger market hubs. And in doing so, they are allowed to deliver, I believe it's time to the 40 minutes, which is a 10-minute difference from last year, and allows them to have the available parts and get there in the same day delivery or next day delivery.
Do you know how they did that? How they cut it 20% from 50 to 40?
Just optimizing the distribution centers.
Because originally they had, what was it, 38, and that was because they had an acquisition back in 2014 of CarQuest, and so they were pretty much operating 2 different network systems. And so when Shane came in, he decided to combine it into just one.
So that increased the efficiency of the different systems.
The balance sheet was a mess a couple of years ago. What does it look like now?
It's much stronger thanks to their sale. They had about $3.5 billion of cash on hand, about $5 billion in debt. So long-term debt is still a problem, but they're pretty insulated from an immediate liquidity crisis because of all this cash they've gotten.
Very good, thank you.
Thank you guys.